One of the most important strategies in investing is dollar cost average, where you invest a fixed amount of money at regular intervals over a certain period of time. Basically, market goes up, you buy. Market goes down, you cry a bit, then you buy more. Sounds easy, right? Apparently not. Because many people often ask me, how do I dollar cost average? Do I buy every month, every week, or every day? How much should I buy every time? Is there a specific day where DCA works better? So, in this video, let's try to answer this once and for all. How to dollar cost average. But as usual, before I start, I would greatly appreciate it if you can help to tap the like button and subscribe if you haven't done so. In return, I will show you a cute hamster. Alright, let's start right now. Okay, let me first try to convince you as to why DCA is such a good strategy. 1. DCA takes emotions out of investing. In a study done by Vanguard, they found that in most cases, lump sum investing actually outperforms DCA most of the time. It doesn't matter what country you are investing in or what's your portfolio composition. Lump sum investing consistently wins. That's because over the long term, the market usually goes to the moon, up. Or more specifically, from 1926 to 2021, there's a 75% chance that the market will go up. So statistically speaking, you will have a higher chance of getting a higher return if you use lump sum investing, where you buy at the start of the run up, instead of dollar cost averaging, where you buy at higher and higher prices during the run up. However, it's easier said than done, because in investing, there's also emotions involved. And when there's emotions involved, we will always end up doing stupid things, like buy high, sell low. Like the 40% of investors who pull out last year only to regret it. Or not buying when it's cheap, only to FOMO in when things start becoming more expensive. That's why even though lump sum investing can give you higher returns over the long term, by doing dollar cost averaging, we are throwing out the emotional part of investing. So instead of thinking when to buy, we are just closing our eyes and buying consistently no matter what's the price, thereby achieving Zen in investing. Second, DCA helps to average down your price. Check out this chart. When the line goes above this horizontal line, DCA outperforms lump sum investing. And when it goes below, DCA underperforms lump sum. What you will notice is that whenever DCA outperforms lump sum investing, it's always during a market crash, like the 1973 market crash, or the 2000 dot-com bubble, or the 2007 global financial crisis. That's because when the market is going up, it's best to all in everything right at the start. And when the market is going down, by doing dollar cost average, you will reduce your average price. Here's an example. Let's say if you were super unlucky and bought at the peak of the dot-com bubble, it would take you 8 long years to break even. Then, when you thought everything is over, you are hit by another crash during the 2007 Great Financial Crisis. Emotional damage. By the time you broke even, you have become an old apet or old ama already. But if you had just DCA all the way down, you will keep reducing your average price and would have broke even by the 4th year. So even though lump sum investing works most of the time, DCA is a super good strategy when the market is crashing left and right, like right now. Quick pause. In Webull's latest update, they have added 2 new features. First, index options trading. So you can now trade options on your favorite index funds. Besides that, they have also added mutual funds trading, which means that now you can finally buy mutual funds and park your idle funds into low-risk Fullerton funds to earn a yield. So if you have not signed up to Webull already, you can sign up using my link down below. Deposit $2,000, buy 1 US stock or ETF with a minimum transaction of $100. Buy 1 US option, all while maintaining a $2,000 net account value for 30 days. And you will receive a $150 cash voucher reward. With that being said, let's get back to the video. Third, DCA takes market timing out of investing. All of us know that the stock market is super volatile, where it goes up and down every day like a roller coaster. And our goal is to always buy at the lowest point, right? Yes, that works in theory, but unless you are God or something, you will never know where the market bottom is. In a study, Charles Schwab found that if you had perfect timing, you will get the most amount of return. Duh! But chances are you suck at market timing and will end up with a much lower return. That's why the next best strategy is to invest immediately or dollar cost average. And interestingly enough, even though lump sum investing gives a higher return than DCA, their returns are actually super similar. In another study done by JP Morgan, they found that over a 20-year period from 1995 to 2014, if you had tried to time the market but missed just 10 base days, your return would drop from 9% down to 6%. Remember, that's just 10 days out of a 20-year period. Miss 20 best days, your return would be even lower. And if you miss 40 best days, you would be getting a negative return, and people will start calling you a donkey already. And here's the most important part. 6 of the 10 best days usually occur within 2 weeks of the 10 worst days. If you check the largest gains for the S&P 500, it's in March 2020 and October 2008, which is right after the largest drop in 2020 and 2008. We also saw that this year in 2022, where the S&P 500 suddenly jumped 5% after the inflation report came out. One day before that jump, the market had been super red. So if you had dollar cost average consistently, you would have been able to catch some of these super green days. Okay, so those were a few reasons as to why DCA works so well, especially during a market crash. Hopefully, you are convinced now, yeah? So, how frequently should you DCA? Do you buy every week, every month, or every day? Or do you buy during the new moon? And yes, that is a valid strategy. Someone found that the market tends to bottom during new moons and peaks during full moons. Weird, huh? You can try dollar cost averaging that way, I guess. Okay, jokes aside, actually, it doesn't matter how often you should DCA. It can be every week, every month, every quarter. Totally up to you. Whichever makes you comfortable, yeah. For me, I don't have a fixed frequency when to DCA. Instead, I try to DCA on red days. Why? Because it feels like I bought it at a huge discount. Yes, that's just how I comfort myself when I lose money on stocks. And funnily enough, Mr. Lu from 1M65 used this exact same strategy. If you watch his live streams often, you will see that he always invests on very red days. So again, it doesn't matter how you DCA. What matters is that you are DCAing consistently. Now, as to how long you should DCA for, according to the Vanguard study, they found that the longer you try to DCA, the worse off it performs. Of dollars and data shows this in a chart. The longer the DCA period, the worse off you will perform compared to lump sum investing. By the time you get to a 5-year DCA period, DCA underperforms lump sum investing 95% of the time by an average of negative 17%. So the moral of the story is, the faster you can dollar cost average your money, the better it is. But what about during a market crash, like right now? If you had DCA in all your money by January, you'll be crying all the way down this year. So let's check out past market crashes to see what's a good DCA period. These are all the bear markets since World War II. There's a few things I want to point out here. First, on average, the decline from market peaks to market bottoms is 12 months, and it took 21 months for the market to break even. 6 out of the 12 bear markets broke even in just a year, while the worst case scenario is during the 1970s Great Inflation, 2000 dot-com bubble, and 2007 Great Financial Crisis, where they took more than 3 years to recover. So if you were to decide based on past data, the optimum period to DCA would be 12 months, where you finish deploying the money when it reaches the market bottom. Take note, yeah, I'm not saying that the market will bottom in 12 months. That's why you should DCA all your money within 12 months. I'm just saying 12 months is the optimum DCA period based on past data, yeah. Every crash is different. It can be a short crash or a long crash, and no one knows how long this market crash will last. So ultimately, just use whatever DCA period that makes you comfortable. The most important takeaway here is to be consistent with investing your money and not to try to time the market, because if you were to time it wrongly, you will end up with a lower return. Finally, here are some tips on DCAing. First, keep the money with the broker. Whatever money you want to invest, don't keep it in your bank account. Always transfer the money to your broker and keep it there. Here's a few reasons. First, you might experience some delays when transferring the money to the broker. Like for interactive brokers, it will take half a day for the money to arrive. So by the time the money arrives, you might miss buying the dip, and that will be bad. Second, some brokers actually give you a high interest when you keep the money with them. Currently, there are 4 brokers that have this feature: Tiger Brokers, Momo SG, Poems, and Interactive Brokers. All of them are currently giving around 3% yield. And best of all, you can immediately use the money to invest whenever you want to. Second, keep war chest money available. This is totally optional, but it's just what I like to do for myself. I like to take advantage of market crashes. So instead of fully DCAing all my money, I like to keep the remaining 10% of my war chest money. Then, if there's any market crash, I can just use the remaining cash and buy the dip. So in a way, you can think of it as an emergency fund, but for investments. But again, totally optional. You don't have to do it, yeah? So those were some DCA tips. In short, how you DCA is totally up to you. Whether it's daily, weekly, or monthly DCA, it's not important. The most important thing is to be consistent with your DCA. And over the long term, when the market goes back up, you will do well. Anyway, that's all for this video. Hopefully, you find it useful. Like, share, and subscribe, as I'll be posting new videos every Monday, Wednesday, and Friday.